Hey everyone, and welcome to this week's version of On the Spot. I'm here with John Paul Hampstead, our Director of Passport Research. JP, welcome back.
Hey, glad to be back, Zach. Thanks for having me.
Yeah, and so of course on the show we talk about what's happening in the freight market this week. You know, JP of course specializes in seeing what's going on anecdotally out there in the brokerage world. Fantastic journalist, and we've had some interesting developments here over the last several weeks. We had Memorial Day this past week.
Yeah.
Memorial Day, which is traditionally a very tight time of year. Like, this is kind of the kickoff of the traditional peak season that we see in June every year. You know, tender rejection rates, spot rates, all that starts to climb significantly. With the coronavirus, the COVID-19 outbreak, we're not really sure what to anticipate this year. We actually thought we would see a muted peak season. However, we are seeing volumes continue their rise, even though we did have Memorial Day off. But we are still seeing a lot of volume growth in the market. What are you hearing out there, JP?
Yeah, we're seeing good volume growth, and I think what's really important is that the industrial base is starting to turn back on in the country. So, I mean, not only have we seen like strong volume recoveries out of important markets like LA, for example, but also like in the Rust Belt. So Chicago, Detroit, Cleveland, Buffalo are all back at sort of normal volumes year over year, which I think is obviously a really positive sign. In certain markets, capacity has been tight enough to actually create an inflationary environment for spot rates. So in the Los Angeles, rejections were over 7%. We're seeing double-digit percentage increases in the truckstop.com spot rates from LA to Dallas week on week for multiple weeks in a row. So at that point, now, rates out of LA are actually higher than they were in 2019, in May of 2019, which is a weak comparison. 2019 was kind of a stagnant, soft year for the spot market. But again, and especially compared to 2018, but let's stop comparing to 2018. Right. Can we stop comparing to 2018? So there are places in the country that are doing really well. Whenever I hear brokers complain about the cost of trucks leaving LA, I know that's good for carriers. And especially this time of year, I think just the market needed a source of relatively high volumes, relatively high rates to kind of go to. Just obviously really interested to see how the summer's playing out. My team right now is working on a whole collection of high-frequency data sets tracking consumer mobility and consumer spending. Credit card data across different verticals and geographies.
We talked about that a few weeks ago.
Stuff like that, and all of most of the important freight-intensive categories are moving definitely in the right direction. And we're going to publish that next week. But one of the really interesting things you can see, we're looking at cell phone mobility data as a proxy for economic activity. So you can still see in states like California and New York that are still kind of underperforming economically. People aren't really moving around as much. Most of the country is recovering and kind of pressing on the gas pedal. I mean, there's a lot of work to do. I think the market and the economy is digging out of a pretty deep hole. Right. But we're going to see fairly fast progress, it seems like.
Yeah, we did a thing on Freightonomics. Anthony Smith and I did on Wednesday, where we took a little bit of a deeper dive into the home improvement and housing sector, and of course the housing sector.
Big surprise. Huge surprise
this week. A positive gain month over month, right, where they were estimating a pretty deep trough, a 20% negative.
Yeah. And so what I saw was April sales of new homes were up 1% from March. They were expecting negative 22%, so it went up by 1%.
Right.
which is really kind of incredible.
I think the point to take away from this, or that I took away from this, is that, a lot of people's expectations are simply to, continue to dig a hole or have this slow recovery pattern, and it's, myself included, but a lot of the data is showing us that we are actually kind of bouncing. Like the middle of April, for whatever reason, was the consummate trough, or the bottom of the market, of the economy. It appears like the worst of the worst in terms of activity, where everybody was still sheltering at home. But the amount of freight volume moving in the country right now is indicative of a 2018 pattern. Not to break your role.
Yeah, I do. I do think that large asset-based carriers are still taking 95% of the freight that's tendered to them, right?
Yeah, it's not resulting in a capacity crunch like a 2018 was,
right,
which was really taken off guard. But the volumes themselves, and again, we are at a much higher capacity situation than we were in 2018. People are more willing to take on this freight. We talked about that earlier in the week with Memorial Day. Traditionally you see tender rejection rates and spot rates shoot up because everybody takes vacations. Well, this did not happen this year. We saw our tender rejection rate go up to like 4.5%, which is historically low,
right,
almost nothing on the spot market in terms of real activity. But we are starting to see, if this pattern continues, this June could be surprisingly tight.
Right, it's been a steady grind upward, and there are a lot of reasons to expect tightness later on in the year if the recovery continues the way it's trending. I mean, you look at everything from truck orders to failures to just the way that even some insurance data that we're working on that we haven't published yet, that we're working on in partnership with Reliance Partners, actually indicates that a huge amount of capacity has been taken out of the market that has really kind of been hidden, or 2019's softness kind of obscured the amount that had been taken out. At some point, the other shoe is going to drop. Don't know when. I do think that spot markets are probably not as robust as they could be. I think that large asset-based carriers are still taking 95% of the freight. They're not, tender rejections on a national basis are still not high enough to cause across-the-board spot rate inflation.
Right.
You're not brokers that are deep in the spot market are telling me that they're not seeing, a lot of spot volume, frankly. So at some points that there's certain pockets of tightness. Again, Southern California, Central California, different places in the country, isolated pockets of tightness where they might have to pay more for a truck, but they're not seeing shippers, flood the market with spot freight.
Now, I was talking to some friends of mine that have, that are in the pricing world, and they were telling me that they have had an inordinate amount of rollouts. And rollouts are, of course, these special projects. They're off-cycle. They're not contracted bids. They are simply
Mini
special
bids.
Projects that are just pressing out, for a limited time. And so it almost appears like these shippers are trying to potentially, and again, these are related to home improvement mainly.
Interesting.
But they are, it looks like these shippers are probably, they're patching. They're not necessarily going all in just yet, but they're seeing this demand cycle kind of out of expectation, where they're going to go ahead and just press forward with these special rollouts and not necessarily, long term it.
I definitely think that trend will continue. Just of sort of like, what do you call them, rollouts, mini bids, project freight.
Yep.
I think that especially the larger, more sophisticated shippers are increasingly using data to accurately measure market prices, to take advantage of whether they're pulling demand forward because they think prices are going to go up, or whether they're just going ahead and taking advantage of low prices when they can, or of capacity. I just think that that's the way more and more freight is going to be priced and moved in the market going forward. I just think that like the annual bid, the annual bid cycles just don't hold up the way they used to. There's too much risk on both sides.
I don't disagree, but these rollouts, again, this is not guaranteed, freight. I mean, it's guaranteed freight volume for whoever wins it, but it's still not consistent. When you're talking about a 2 to 3 month cycle, again, that's about the size of a normal freight cycle, about 3 months. Every quarter we have basically a new freight market or a new freight pattern. So it could be effective, in my opinion. I don't know if it's going to be something that the shippers find to be long-term beneficial. I think at this point in time, we're looking at a situation where, like you said, we have shippers very uncertain. We heard about the capital expenditure budgets being slashed. We see that pretty consistently. But if demand comes back quicker than anticipated, which you're seeing in some of your credit card data right now,
certainly,
depending on the sectors, you've got the automotive industry coming back online, which again looks a lot like what we saw in October, November last year, where you have this initial spike while they get up and running and get going, which again causes disruption to freight networks and freight patterns traditionally in the United States.
Yeah, and that's really going to, and the automotive supply chain really runs mostly through the middle of the country, from Ontario,
all the way
Canada, through Mexico. But really, through the Midwest, and then through even through like the sort of the Mississippi River area. So even states like Alabama, Mississippi have like a decent amount of auto production. And then of course you have all the plants. You think about like Ohio and places like that are all involved. So that's a really interesting corridor for freight that I think a lot of people, when they think about autos, they think about large Rust Belt cities. But it's really a north-south supply chain that goes across 3 countries.
Yeah, and of course we have produce season right now, running out of California and Florida, a little bit out of Florida, but mainly California. You have the lettuce, the strawberries, and all the things that come out of California. They're going right now, and we've seen inflation on the rates out there
onions
as well.
Out of New Mexico, just a lot of different commodities are being produced right now, and it seems like it's going to be a pretty big harvest and a big year for produce.
It looks like if this holds up, we could have a better produce season in terms of spot market or spot rate activity than we did in 2019.
Yeah, I think that I wrote about this last week, I think, in the Passport Research, if you want to check that out. But it seems increasingly likely that reefer carriers are actually, kind of despite the odds, set up for a pretty good year. There are some brutal periods, certainly for dry van, coming off of basically 18 months of really soft, unfavorable business conditions. But reefer did really well in the coronavirus sort of ramp in March, and then has continued to outperform. It looks like produce is coming on really strong and is actually tightening capacity where produce is being produced. And
fresh produce is in high demand right now, with everybody going to grocery versus restaurant, even though the restaurants are coming back a little bit.
Yeah.
So real quick, we got a minute left. So what do you think the next sector to wake up would be to watch out for in the market?
I think retail will be. I think that people may try to make up for lost time this summer in terms of getting out and going outside. When you look at some of the steepest year-over-year declines in spending, you look at things like apparel, which is down like 80%.
Right.
That has to come back at some point, and that's probably going to see a pretty sharp recovery once people feel more confident about spending money on things they don't need.
Yeah, right. Well, good stuff, JP, and thank you for watching as always. Stay tuned to FreightWaves.com for all of our future freight market updates, and hang on for the ride. It's going to be an interesting. It's going to be an interesting summer, I think, JP.
Oh yeah.
I think we're going to have an interesting couple of months in the freight market, and certainly we will do our best to keep you up to date with all that's happening. Have a great week.